So now what we're going to do is we're going to sharpen our pencils, and we want to show you how a true real estate investor would look at that cash flow sheet and analyze those numbers. Okay? So here you can see the cash flow pro forma that we just laid out for you. So really, when you look at this, your positive cash flow is $124 a month. Now, if you multiply that by 12, which means 12 months in the year, you have $1,488 of positive cash flow during the year. And your total investment here isn't not the $160,000 you paid to buy the property. It's actually the $32,000 that you put down. So your return on your investment based on positive cash flow is 4.6% annually. And a lot of investors would only look at that and say, well, that's really low. I don't want to do this. But that's not looking into it far enough. So the second profit center that we'll look at in real estate is the mortgage pay down. So with an original loan of $128,000, with the mortgage that we assumed, you're paying off $239 a month. So times 12 months, that's about $2,868 that you're paying off each year. That's equity for you. When you look at that amount divided by your investment, which is your down payment, $32,000, that represents a 9% annual return for the investor. That's a very decent return. So now, based on where Alberta is right now, it's just had a correction for 3 years. It's entering a recovery phase with the job growth that we've shown you in the oil sands and the construction jobs. And it's very realistic in a GDP growth climate of 3 to 4% to assume a 3% appreciation rate of your property. So what this means is your property would increase in value about $4,800 a year. And when you divide that by your original investment, that gives you a 15% annual return.
Well, Lindsay, I might just add here that 3% is actually on the conservative side, because we've seen that between years that actually weren't that good, people don't remember, between 2003 and 2005, we averaged 6% in the residential market.
Okay, that's a very important to consider. And so we're just trying to be really conservative here at the numbers. But, I mean, when you add them all up, so you add this all up, and you're looking at a 28.6% annual return based on these assumptions. So even if real estate increased more than 3%, it'd be phenomenal. But what we're trying to show investors is this is a very low-risk, conservative estimates producing phenomenal returns. And when we show this to people, these type of returns, and they learn how real estate creates wealth over time, they have no reason to be involved in the stock market and taking the risk of paper assets and the volatility of the stock market. There's just no value in that for a lot of our clients. And they switch over, take the money out of the stock market, and they really want to get involved in these type of properties, especially with the timing of the real estate cycle and where we're at right now. And a 28% return annualized is actually outside of a lot of people's contexts. And the reason we go through these numbers is to show you that it is possible. And when you get these type of returns, you can create financial freedom in a much shorter period of time. So here, when you look at real estate, why we're doing real estate, and you look at the 10 years later, once you buy these properties, just with the conservative assumptions that we've laid out for you, you can reasonably expect to have about $119,000 in equity in just one property at the end of 10 years. And it's very important to realize how this equity happens. And so when you look at this and you think, well, how much money will I need to retire in 10 years? And a lot of our clients will look at that and say, well, I need 3 more of these, or I need 5 of these to add to what I already have to create financial freedom for myself in 10 years. If you look at 20 years out, you're looking at almost $250,000 in equity if you just own one. Okay, so why not get started and start looking at some properties? So if this is so good, though, what the question we ask is, how come people aren't all doing this? Okay, and there's a number of reasons for that. Here you go. This is you on your holidays when you own revenue properties. You don't want to be doing this. People do not buy revenue properties for 3 main reasons. They don't want to do their own maintenance, and it's too much work and too much expense for them. People are afraid of vacancies. They don't want to show up to the revenue property and see it empty, and there's no one to pay that mortgage for them. And also, people don't want to chase renters. Sometimes people will stay in your suite, but they won't pay you rent, and that's even worse. So people don't want to deal with tenants, and there's a lot of rules around the Property Landlord-Tenant Act. So it's something that people don't want to deal with. And very happy to say that with Vision Investment Properties, we've created a platform for investors that takes all these headaches right out of owning real estate, and we make it completely turnkey for the investor. And we take care of all these issues with maintenance, with vacancies, and we have a rental assurance program we'll talk about, and we have a property management to take care of everything for you. And this is what really helps people get motivated to get more involved now to invest in real estate. Yeah, so with Vision Investment Properties, we have a very unique strategy to help you want to get involved now with real estate investing. We take the headaches and risks away from the real estate investments as much as possible. So we have a very unique 4-year rental assurance program, and we haven't seen this anywhere else in the industry. It's very unique. We also have a rental pool program, which you get involved with after the rental assurance runs out. And we also have property management in place for you, and you also get direct ownership, 100% title in your name. So let's just break this down for the investor. So when you look at our rental assurance program, let's use our current property as an example. So right now, Best View Manor has 31 suites or 31 different individually titled condominiums. And so Vision Properties has set aside $93,000 in escrow with the lawyers. And so what happens is anytime during the first 4 years that one of our clients owns one of these properties, if there's ever a vacancy, say the rent's $1,000 a month and that unit's vacant that month, they'll still get paid their rent even though it's vacant. And that money comes from this $93,000 that Vision set aside in escrow with lawyers. And so it really reduces a client's risk for missing rent, and it helps secure that annual return they're looking to get because they're going to get their rent every single month. And so this is a 4-year program, and we do not expect that $93,000 to run out. But what it shows our clients is that we're so confident with our properties, we're willing to take on that risk of the vacancy rate. So with this program, it ends either when the 4 years is up or if the $93,000 runs out.
So this is one of the real key reasons why someone would want to buy through Vision instead of buying on their own. They're not going to get an insurance program like this one for the first 4 years.
This is a key reason why our clients invest with us, because most people like to own 3 or 4 or 5 properties, but they're far too afraid of the vacancy risk because they can't afford that if they get a couple of properties vacant at once. So with us, you don't have to worry about that at all. And this is a major part of our platform. And it's really important to point out, Trent, that we offer this for free. Okay, there is no charge for this, but what it shows you is how confident we are with our properties, and we're gonna take on that vacancy risk for you.
So I guess now, they're doing this and putting this in the bank because essentially what they're doing is they're buying a mass quantity of units at a time, which is allowing them to negotiate a price that's more than reasonable.
Yeah, okay, so you bring something up that's very important. So with a typical property, and using this one as an example, Vision Investments might buy it for $140,000 a suite, because we're acquiring the entire property at once from the owner. But so we acquire it for $140,000. We might sell it to our investors for $160,000, but the market value or appraised value is about $180,000. So it's a true win-win situation for everybody involved. Vision might make $20,000 a property, but the investor gets $20,000 equity day one. So it's a phenomenal system, win-win. And this way we don't have to charge you any fees. There's no profit sharing. All the equity and all the cash flow is the investors. Okay. So with the rental assurance program, what's happening here is you can see the onus is really on Visions to make sure that the property manager does a great job of managing that property. Because if the property manager doesn't do a good job, it doesn't cost our investors money. It costs Vision Investments properties. It costs us money. So we're taking on the responsibility to make sure that property is managed very well, and it's fully occupied.
So it's important to say that when we talk about managing a property manager, we're not talking about somebody who collects the rent and just cuts the grass. We're talking about property management, meaning they find the renters too.
Yeah, so the property management program, that they take care of everything. So they're going to be screening tenants, interviewing tenants, placing tenants, collecting the rent. If someone needs to be evicted, they're going to deal with the eviction. They're going to deal with everything. If someone damages a suite, the property manager is going to take that person's damage deposit and use that to fix the suite. They're going to have that taken care of for the client. So really, all the client has to do here is they're going to get a statement in the mail once a month, and they might have to hole punch it, but they're going to put it in the binder, and that's about all the clients have to do. So that's when we say it's 100% turnkey, that's what we mean. It's all taken care of. Okay. So now, once the rental assurance program runs out, and we're gonna stay on our strategy here with this slide, but once the rental assurance program runs out, we go to a rental pooling program. And so even once the rental assurance runs out after, say, 4 years, it's not like you're out on your own and now the risk starts. So we go to a rental pooling program, and I'll just explain that for a minute. So how a rental pool works is what it does is say you own one of the suites, and rather than your rent going directly from the renter right to you as an owner, the rent first goes into a pool, and then it's divvied up equally amongst the owners. So here, if each unit rented for $1,000 a month, and there was only 5 suites, the total rent collected would be $5,000 that month. And then that's split up equally amongst the owners, so they each get $1,000 a month. Now let's assume one of these units became vacant. So then the total amount rented, or total amount collected that month would be $4,000. And when that was divvied up equally amongst the 5 owners, each person would get about $800 a month. Okay? So it really reduces an owner's risk. So here, no one's really out the full $1,000. But this isn't the best example because it's only 5 suites. Let's say there were 31 suites, like in the opportunity we're offering, and maybe 1 or 2 of them was vacant. Instead of getting your $1,000, you might still get $920 or $950. So it's really going to be risk reduced for the investors. And the rental pooling program, I mean, I've owned a number of properties in rental pools for almost a decade, and it's a phenomenal system. And I personally have never had to come up with my own money to pay rent, not even once, with my properties in rental pools. So it's a great way to get the place back to fully occupied when you have maybe 1 or 2 or 3 vacancies, and away you go. So that's how a rental pool works. Hope that makes sense. It's fairly simple. So now, just to summarize, you're getting 100% title on the property that you buy. We have the 4-year rental assurance program to minimize any risks for you with lost rent. We have cash flowing real estate, so we're focusing on a really nice sweet point. Properties in Alberta, around $150,000, $160,000. So that's going to pay for itself and build equity for you over time. We hire the property managers. We put them in place for you, and you don't have to take care of any issues with the tenants. You control your investment. So down the road, you can refinance it when you want, sell it when you want, or you can even move into it if you want. And so it's very beneficial for the investors with full control. And when you look at the equity you build over time, even with just one property, you're looking at about $120,000 at the 10-year mark and approximately $250,000 after 20 years. So owning a few of these, we would help you achieve your goals, and sit down with us, and you can help show us where you're at today, and we can try and help you reach your retirement goals. Maybe you want to retire in 10 years. We can help place a few properties for you and have you financially free on your timeline and get you away from the risks of the stock market. And just a summary, with a 20% down payment, keep in mind you're looking at about a 28% annual return based on a reasonable expectation. Okay? So hope you like what you've seen here today with Vision Investment Properties. And Trent Gustus with Keller Williams is more than happy to handle your inquiries or show you information around our properties. And we've got a lot more information. You can get access to our website and background due diligence that we've done on our properties, just with a request for a username and password. So ask us for that. And all the due diligence that we do on our properties before we buy it is all collected and saved for our investors to review. So that's there for you. If you would like more information,
Lindsay, Lindsay, I got a couple of questions for you here. One of the questions I might have is that there's not an infinite number of opportunities at any given time. So, in other words, some people might be thinking, well, they can buy any time because there's always another opportunity. And yes, there is, but certain projects are, of course, maybe more desirable than others. Isn't that the case?
Well, yeah, we only do one project at a time, and typically it's about 30 or 40 suites. So the average property will sell out fairly quickly within 6 to 8 weeks. So they're very, very popular. They're in high demand. We've got about 15 different representatives who each have hundreds of clients. So it's just a matter of people taking the time to do the due diligence, and getting it pre-approved at the bank is a good idea. And you can reserve a suite for maybe 3 or 4 days, and then you pretty much have to move forward with the paperwork, or else we'll take it off reserve list. But they do sell very fast, and we do have a new opportunity approximately every 3 months.
Now, you just mentioned a reserve list. What is that?
So if you're very close to making a decision, you can reserve a property, and so you'll look at the suites that are available, and you'll pick a particular suite that you might prefer. Maybe it's on the front, maybe it's first floor, maybe it's fourth floor, maybe it's a corner unit. You'll pick and not all the suites are priced identically. First floor, one bedroom might be, $140,000, whereas a top floor corner unit might be $175,000. So we don't price every suite in a building the same. So, but if there's one you particularly like, you need to get it reserved, and then you can fill out a purchase contract within 3 or 4 days. And it's a great way if you're excited about it, and you have a suite you really prefer, but you have a few things you'd like to do yet on your own just to make sure. Then it's highly recommended to make a reservation.
So typically, Lindsay, what is the time frame for things? If you were to buy a unit, when would you get title? When would it start becoming rented? These kind of things.
So when you there's a few forms to fill out, a purchase contract, a few things like that. It's not much paperwork, but what happens is you need to put a $15,000 deposit on the property, which goes in with your purchase contract, and it is refundable if you decide not to buy the property. And then you need to... So it's a conditional
offer, then, is what you're saying.
Yeah.
It's a conditional offer upon financing, right?
That's correct. So then the purchase contract comes directly into Vision Investments, and then you'll have either you can pick a mortgage broker for yourself, a lender, or preferably you would use our list of lenders. We have a list of mortgage brokers who are very experienced at providing mortgages on these types of properties, and so we highly recommend that you go with one of our team members. We actually will shop for you, because we're a full turnkey operation. We will shop for you the best mortgage rates. So we do have about 8 different mortgage brokers we work with, and when your purchase contract comes in, we will shop 8 different mortgage brokers for you, and they'll go out to their lenders, and we can get a rate that's phenomenal, typically much better than anyone gets on their own, just by going to one mortgage broker. So we're really hoping you'll use our system that's turnkey for you. You got to get it pre-approved for the financing and get the mortgage in place. This takes about 4 to 6 weeks to get everything in place, and then the legal documents. We have a lawyer that we use for every single suite, and then they would prepare the mortgage documents and the closing documents for title. And then that would go to your notary or your lawyer, where you do the final signing.
So up and running, even if you made a commitment today, you'd be maybe 2 months away.
To be all closed out at the maximum 2 months.
Okay. All right. So it's not typical to some real estate purchases where you could be having the property within 3 to 4 weeks then.
That's correct.
Why would there be an additional time there?
It just depends for different reasons, but for example, like with the property we're doing now, we've set a specific close date in January. So January 11th is the close date, and all suites will close on the same day. And for this particular property, we have the owner is a developer and who builds hotels and condominium complexes, and he's retiring, and so he has title to the entire property. And so we're having 31 different buyers buy a suite. So we're having a close date all in one day. So sometimes that's a reason why the close date is just set to be the same for every investor. And then it's just the time it takes to get a mortgage and get everything closed out with the lawyers.
Okay, thanks, Lindsay, and appreciate your time. And if anybody wants to invest in this, they can either fill out a form on the computer screen if there's one there, or just give us a call at 403-862-9610, and we'll be happy to answer your questions.
Okay, great. Thanks a lot, Trent.